Hello and welcome to the Mutual Fund Guide. It's all about your funds and your returns. I'm Vandita Shivle. Joining me on the show today is Kshitiz Mahajan, co-founder at Complete Circle Consultants. Welcome to the show, Kshitiz, and thank you so much for joining us today.
Thank you, Vandita.
Yes. So, Kshitiz, before we begin with our question and answer session, I just wanted you to give a perspective to our viewers about actively versus passively managed funds.
Okay. So, that's a good question you have asked, and in these times when we are seeing the entire mutual fund sector is going through a lot of changes in terms of the expense ratios also. So, when you talk about a passively managed fund, these are basically index funds or ETFs, wherein you just bank on one of the ETFs, let's say index, that you want to have your return as per index. Right. Somebody can have a Nifty 50, BSE 200, Nifty 500. And there are funds who just mirror image these indexes. Right. It's in the form of exchange traded fund which you can buy on stock exchange, or it's in the form of index funds also. When I say index fund, these funds just mirror image these indexes at the same time at a very low expense. So expense for any ETF is in the range of 30 to 50 bips. For an index fund, it's in the range of 100 bips. That's in 1% to 1.5%. That's how it is. So yeah, it's a good strategy to have one fund at least on the index side, because index keeps on surprising you. What we have seen last year also, that most of the funds struggle, active funds have struggled to outperform index funds. But that's one of the years where we see that index run up has led by 7-8 stocks particularly. But yeah, globally the trend is of passive funds only. People put in index funds and ETFs only, and that's the right way to look at going further. But in India, we have a lot of opportunities on the active side still remaining, and you see that active funds will keep on outperforming index funds in next at least 3 to 4 years time. Having said that, one should have one, if for long term they can have one fund on the passive side, and they can add either ETF or an index fund in their portfolio.
All right. So that was the perspective coming in. You can add an index fund or ETF fund for a better portfolio. Let's move on to our first caller, Mr. Naveen Rao, who's online from Mumbai. Very good afternoon, Naveen. What's your question? Hello, Mr. Naveen. Are you there? Are you able to hear us? I think there's some disturbance, but he'll be back. Naveen, can you hear us? All right. So I have his question with me, so maybe we can proceed with that. So basically, Naveen has invested via lump sum of 10 lakh rupees in ICICI Prudential Liquid Fund. And he's doing a SIP of 1000 rupees in ABSL Tax Relief 96 Fund and Axis Long Term Equity Fund. He's investing 500 rupees in each BNP Paribas Mid Cap, DSP Mid Cap, SBI Magnum Mid Cap and UTI Mid Cap Fund. He is investing for his daughter's future. He wants us to review the portfolio and provide guidance.
So, Mr. Rao, point is that money which you have participated in ICICI Liquid Fund, if the money is for 1 year's time, my suggestion is just switch it to the ICICI Ultra Short Term Fund part.
All right.
Now, where you get 6.5 or maybe close to 7% return in liquid funds, I think 6.5 is the right figure to imagine. In Ultra Short Term Fund, let's say in ICICI Ultra Short Term Fund, right now the YTM is close to about 9+, and where you have modified duration close to about 0.26, and at the same time expense close to about 0.96. So easily you can make 8% in short term in terms of 6 to 8 months time. On an annualized basis, 8% return can come. So it's going to be 100 to 125 bips, delta from what you're getting right now of the same category. Obviously, liquid funds, vis-a-vis ultra short-term fund has almost same feature. It's just that mark-to-market element is there in ultra short-term fund, which is not there in liquid fund. Right. But the money is there for a year's time. You should participate in ultra short-term fund. Second, if the money is there for a little long, maybe let's say for 3 years' time, then run just rather than keeping it in your liquid fund or ultra short-term fund, you should switch to balance funds, because here in the opportunity cost you are missing on. When you participate in any debt fund, you just preserve your wealth. With a country where we have right now maybe 8-10 quarters looks good in inflation, but as a history speaks, it's in excess of 8%. So my suggestion is that you should look at balanced funds which can give you 10 to 11% return over next 3 to 5 years time. And if you want to go a little conservative, look at balanced advantage fund category where you have, a mix of debt, arbitrage and equity fund with equity taxation. This is what you should look at for your lump sum investment. Now coming back to your SIP, right now you're running with 4,000 rupees SIP wherein you have 6 funds, 2 funds in tax saving and 4 funds in your mid-cap funds.
Right.
So number of schemes, first of all, we should reduce to from 6 to 5 because 4 to 5 funds are good enough. You can continue with your tax saver fund. Both the tax saver funds are good funds, but all 4 remaining funds are mid-cap funds. That too aggressive as a portfolio. You should retain one of the mid-cap fund. Let's say you can keep DSP mid-cap fund, and balance you can just add 2 multi-cap funds. You can add Kotak Standard Multi-Cap Fund and SBI Focus Equity Fund. These are the 2 funds you can add in your portfolio. And as and when you have some more cash flows coming in your way, keep on adding to your SIP.
Right.
Now, when you say you have 4,000 rupees, which is going on at 12%, if you keep this money for 15 years, you'll make close to about 20 lakh. If you keep this money for 20 years, you'll make 40 lakhs.
Right.
Now, if this 4,000 will grow to 10,000, let's say, over a period of time, and at 12% for 15 years, it will give you 50 lakh, and 12% for 20 years, it will give you a crore. So, as and when you have cash flows, keep on participating. And if you want this 10 lakh rupees, which is lying in liquid fund for long term, my suggestion is just keep on start doing STP from these funds, from liquid fund to various these equity mutual funds.
All right. So that was for you, Mr. Naveen. We are really sorry that we couldn't connect with you, but we really hope that your query was well answered. Let's move on to our next email. That's from Amit Sinha, who's from New Delhi. He has emailed us. He's currently investing through SIP in Access Long-Term Equity, Franklin India Focused Equity, Franklin India Smaller Companies, DSP Small Cap, ICICI Prudential Value Discovery, ABSL Dynamic Bond and Miri Asset Emerging Blue Chip Fund. Since 2 years, he has been increasing his SIP amount as well, annually by 10%, and would like to continue with the same strategy. He is asking basically, how is his strategy? If we could also comment on the portfolio in terms of fund selection, should he stay invested or switch? What's your recommendation, Kshitiz?
So Ahmed, my compliments to you looking at the selection of funds. Very good fund selection you have right now in your portfolio, and at the same time you're increasing your SIPs every year by 10%. That's also a good amount of money which you are adding on to your SIPs every year. You don't have to change your funds, you just need to reduce your funds. Right now you have 7 funds, so you can reduce it to 5. There is no need for any dynamic bond fund SIP in your portfolio. So fixed income funds are for lump sum investment less than 3 years.
Okay.
So there is no need for the SIP and dynamic bond fund. You can stop that SIP, and you can stop Franklin India Focus Equity Fund. Remaining 5 funds are doing very well. You can shift the money from which these 2 funds you are participating in other 5 funds. Just continue with these 5 funds. They are one of the best in their category, and keep on increasing your SIP as it rightly done by you. So 20,000, which let's say for right now you are doing SIP, just for example, if you are doing it for 15 years, it will give you a crore at 12%. If you do it for 20 years, the same amount will give you 2 crores. So because it's not mentioned how much amount of SIP you are doing. So my suggestion here is just keep participating, keep increasing, and you'll actually realize the benefit of SIP over a long term only. So keep on adding SIPs.
All right, so that is the advice. Do not change your funds, but reduce your funds. That's the perspective coming in for you. Let's move on to our next caller, Mr. Gajananan Gavli, who is online from Pune. Hello and very good afternoon, sir. What's your question?
Hi ma'am, this is Gajanan, and I have queries on SBI mid-cap fund particularly because the fund is not performing well in the last 3 years, and it is the below category performance. So I would like to know about that, and I have some other funds also like ICICI Services Fund Export, ICICI Value Discovery, and SBI Blue Chip. So I want to know whether I can continue for wealth creation.
Obviously, definitely we'll let you know that. So Kshitiz, what do you suggest?
So Mr. Gavli, when you talking about the last 1 year or 2 year return on the mid cap, SBI mid cap is not good. I can understand overall index has not done well, and mid cap as a stock category also have got a lot of bidding. So having said that, it's a good fund, but if you look at your portfolio where you have SBI Blue Chip Fund, which is a large cap, one of the best in its category, SBI Mid Cap, which is a mid cap category, then you have ICICI Export and Services and ICICI True Value Discovery Fund.
Right.
and you are totally doing SIP of 14,000 right now. So my suggestion here is please continue with ICICI Value Discovery and SBI Blue Chip Fund, and at the same time from SBI Magnum Mid Cap you can move to SBI Focus Equity Fund, which is a multi-cap category, very focused fund, and you can shift your portfolio as monthly SIP to SBI Focus Equity Fund and add one more multi-cap fund. You can choose between Kotak Standard Multi-Cap or ICICI Multi-Cap Fund. So have 4-5 funds in your basket and continue SIP there. Now the beauty of multi-cap fund is that it has a open allocation towards large cap, mid cap or small cap. Fund manager can take a call at his level that whether to participate more in large cap or mid cap or small cap. Right now most of the multi-cap funds are large cap oriented. You see 65 to 75% is in large cap only. But tomorrow if they feel that there is a value unfolding in mid cap or small cap, they can shift there also. So rather than doing it at your end, just allow fund manager to do the task and you can look at this portfolio.
Right. And what do you think about this ICICI Prudential Exports and Services Fund?
So I recommended in place of that he can switch to either ICICI Multi-Cap Fund or Kotak Standard Multi-Cap Fund. Because it's a pure export and services fund and it's been there for 2-3 years time. And I see that you have better earning numbers coming from other two funds. So it depends on what cash flows and earnings you're generating in the portfolio. That's how your returns will come.
Absolutely. So that's how you can generate the returns that you're looking for, Mr. Gavli. Let's move on to our next email. That's from Tarun Murari, who's from New Delhi. He says he works for a public sector bank and he has an NPS account, which is National Pension Scheme account. So as they give tax rebate as well. Should he invest in ELSS too, or will he get tax rebate on his NPS account only? I'm not sure, like, because if Section 80C is already taking care of his one, according to that section, 1,50,000 you could save on taxes.
Right.
So I'm not sure that if adding in ELSS fund would help.
So Vandita, what happened? It's a very vast topic to touch base on, and I think this show is not good enough. But the time which we have, I'll just try to summarize it.
Right.
NPS, as a government employee, 10% of his salary goes into NPS.
Right.
That gets deducted. But there's a cap of 10% of your salary or 1,50,000, whichever is higher.
Right.
At the max, you can go at 1,50,000, and it's a part of ATC, as rightly said by you. There's no separate any provision or separate benefit which you get. It's in the tax saving only. When you are an employee, obviously you have to do, but at the same time the benefit which you get when you invest into a ELSS is that locking is only for 3 years. NPS till the time of retirement you need to have money in NPS, and you can withdraw 25% if you have completed 3 years in NPS of the amount. Now after 60 years of your retirement, or let's say 60 years of your age, and then you get retired, you can take out 60% only, and 40% you have to keep with the National Pension Scheme, wherein on a monthly basis you'll get a your pension out of it. That's why they deduct NPS. Now what you getting now, they have a provision of it, you can go up to 50% in equity. I mean, it's not there. I would have suggested if you can avoid, please avoid. I don't know whether that provision for a government employee is there or not, but because now you have 50% equity, it works like a balanced one. So if you have an NPS which is going on a monthly basis, first of all opt for a 50% equity participation. That is something which you do. So you are not missing on a major part by not participating into ELSS. First is this. Second is, if you have anything spare for your tax provisioning, if 1,50,000 getting deducted, then there is no other provision which you have for tax saver. If let's say your basic, if your salary is 10 lakh and 1 lakh it is getting deducted as NPS, add 50,000 on a yearly basis to ELSS also. Now let's say if your entire money is getting deducted as NPS, then you can add multi-cap funds in your basket.
Right.
So rather than just sticking on to that, we should have a ELSS fund only. If your tax requirement has been covered by NPS, you can do ELSS. Rather than doing ELSS, you can do open-ended funds also. So that can solve your purpose of investing and getting the right return.
And maybe he gets better returns.
Yeah, anyway, because if you see NPS has given over the last 10 years time 8 to 10% return. Any multi-cap fund which you actually pick and choose for last 10 years has given in excess of 17-18% return. Having said that, my request to all investors and all viewers who are watching this show, just keep a modest expectation of 12% return from equity mutual funds. Anything which you are getting over and above that is a bonus. So 12% is the right and modest expectation, because in 12% you will double your return double your money in 6 years as a rule of compounding. You will quadruple your return in 12 years, and you will make your return 8 times in 16 years. So 18 years. So I'm saying that one should understand that power of compounding can help you to generate or to achieve your goal with 12% also.
Absolutely. And like if he really wants to still invest in ELSS funds, I think January to March quarter, that this phase is really good for investing in ELSS funds.
Right.
So you can look for that, Mr. Tarun. So that's all for this edition of the Mutual Fund Guide. Viewers, save, invest and prosper with the right guidance right here on Business Television India. Thank you, Kshitiz, for joining us today. Stay tuned for more news and updates on the other side.